6 months ago, my brother Anthony drained $184,000 out of the business we co-owned, wired it to an account I didn't know existed, and told me the company was simply going through a rough patch. 3 weeks later, I got a phone call, not from Anthony, from the Internal Revenue Service. Because here's what my brother didn't understand when he quietly emptied that account. Our business wasn't just mine and his. It was ours, on paper, in every legal and financial sense, which meant that whatever debts, whatever red flags, and whatever obligations came with it were also mine and his equally. He thought he was getting out clean with the money. What he actually did was leave me holding a company that now owed the federal government money he had already spent. But my brother made one mistake in all of this, a mistake that 6 months later cost him considerably more than the money he took. Stay with me, because by the end of this video, you're going to understand exactly how a business account, an IRS letter, and one very carefully worded contract turned my brother's escape plan into the worst financial decision of his life. Anthony is 2 years older than me. Growing up, he was always the one with the big ideas, the entrepreneur, the risk taker, the guy who could talk anyone into anything. I was the steady one, the planner. I went to school for accounting, worked at a mid-sized firm for almost a decade, and built a reputation as someone who could be trusted with other people's money because I never took unnecessary risks with my own. 8 years ago, Anthony came to me with an idea for a commercial landscaping and property maintenance business. He had the industry contacts, the charisma to land clients, and the willingness to work long hours building it from nothing. What he didn't have was the discipline to manage the financial side of a growing company, the invoicing, the tax filings, the cash flow planning that keeps a business from quietly falling apart, even while it looks, from the outside, like it's thriving. So we became partners, 50-50 ownership, formalized through a proper operating agreement that I insisted on drafting carefully, precisely because I understood, even back then, that mixing family and business without clear structure is one of the fastest ways to destroy both. Anthony ran operations and sales. I ran the books, the taxes, the financial planning. For the first 5 years, it worked beautifully. We grew from 2 trucks and 4 employees to a company with 11 employees, a fleet of 6 vehicles, and contracts with several commercial property management firms across the region. Then, about 3 years ago, I got remarried, my wife and I had our second child, and I made a decision that, in hindsight, opened the door to everything that eventually happened. I scaled back my day-to-day involvement in the business. I still reviewed the books quarterly and signed off on the major financial decisions, but I handed the daily bookkeeping over to Anthony's new hire, a woman named Rachel, who Anthony had brought on and who reported, in practice, primarily to him rather than to me. I trusted my brother. I trusted the systems we'd built. And for 2 years, that trust seemed, from where I sat, entirely justified. The first sign something was wrong came about 10 months before everything fell apart. I noticed, during my quarterly review, that our accounts receivable had grown unusually large, meaning clients owed us significantly more money than usual, money that hadn't yet been collected. When I asked Anthony about it, he waved it off as just a slow collections quarter, happens sometimes, and promised it would even out. It didn't even out. Over the following months, I noticed other irregularities. A new equipment lease Anthony had signed without running it by me first, at terms that struck me, even at a glance, as unnecessarily expensive. Payments to a vendor I didn't recognize, which Rachel explained when I asked, as a new subcontractor for the bigger commercial jobs. Payroll numbers that occasionally didn't quite match the employee count I understood us to have. Individually, each of these things had a plausible explanation. Together, over time, they formed a pattern that made me increasingly uneasy. The same kind of quiet unease you feel when you can't point to any single piece of evidence, but something in your gut insists that the full picture isn't adding up. I raised my concerns with Anthony directly, more than once. Each time, he responded with a mixture of reassurance and mild defensiveness. "I've got this handled, Mike. You don't need to micromanage every invoice." Or, "This is exactly why you need to trust me with this side of things, the same way I trust you with the tax stuff." I wanted to trust him. He was my brother. And for a long time, wanting to trust him won out over the small, persistent voice telling me to look closer. The moment everything changed was a Tuesday afternoon in early autumn. I'd logged into our business banking portal to review the account before a scheduled call with our accountant about upcoming quarterly tax estimates and found something that made my stomach drop. Our primary business checking account, which typically held anywhere from $60,000 to $90,000 in working capital, showed a balance of $11.42. I checked the transaction history immediately, assuming at first that this had to be some kind of banking error. It wasn't. Over the previous 11 days, a series of wire transfers, 6 of them, ranging from $20,000 to nearly $40,000 each, had moved a combined total of $184,000 out of our business account and into an external account I did not recognize, at a bank we had never used for any company transactions. I sat there staring at the screen for what felt like a very long time. I remember reading the transaction dates over and over, as though repetition might change them. $22,000 on a Wednesday, $38,000 the following Monday, another transfer 3 days after that. Whoever had done this had clearly been deliberate about it, spacing the transfers out just enough that no single one would have triggered an automatic fraud alert from the bank, while still moving the entire sum within less than 2 weeks. I called Anthony immediately. He didn't answer. I called again. Nothing. I texted him, asking him to call me back urgently, that something was wrong with our account. Nearly 4 hours later, he finally called back, and the conversation that followed is one I remember almost word for word, because I recorded it, a decision that, as it turned out, would matter enormously in the weeks ahead. "Anthony, where is $184,000 from our business account?" There was a long pause before he answered. "Mike, I need you to stay calm. Things have been tighter than I let on. I moved that money somewhere safe, temporarily, while I figure some things out." "Safe from what, Anthony? Safe from me? I'm your business partner. What is going on?" Another pause, longer this time. "The business is in trouble, Mike. Bigger trouble than the books show. I've been juggling some things, and I needed to protect some of our assets before everything gets complicated." Complicated how? And that's when Anthony said the sentence that, months later, would become the single most important piece of evidence in this entire story. "Mike, I think the IRS is going to come after us for payroll taxes we haven't been fully paying for over a year. I moved the money so we'd at least have something left, whatever happens." Over the following days, with the help of our accountant and, eventually, a business attorney I retained independently, the full picture came into focus, and it was considerably worse than even that first phone call suggested. Anthony, it turned out, had been misclassifying a portion of our workforce. Several employees who should have been on payroll with proper tax withholding had instead been paid as independent contractors for over a year, a classification that significantly reduced the company's short-term payroll tax burden, but was, according to our attorney, almost certainly not defensible under IRS guidelines given the actual nature of their work and schedules. On top of that, quarterly payroll tax deposits, the withheld income tax and payroll tax that a business is legally required to forward to the IRS on behalf of its employees, had been falling behind for nearly 14 months. Not missed entirely, which might have triggered earlier scrutiny, but consistently underpaid, in amounts small enough each quarter to potentially go unnoticed, but large enough, cumulated over more than a year, to create a substantial and growing liability. Anthony had known about this liability building for months. He had not told me. Instead, according to what we later reconstructed from bank records and Rachel's own statements once she was brought into the investigation, he had quietly begun pulling money out of the business over several weeks. Not in one large, suspicious transaction, but in a series of transfers designed to look, individually, like routine vendor payments or equipment financing, until the final 6 transfers in that 11-day window, made once he apparently realized the IRS scrutiny was imminent and decided to move as much as possible, as quickly as possible, before any freeze could be placed on the account. He had emptied the account we jointly owned, in other words, specifically because he knew a significant tax liability was coming, and he wanted to make sure that whatever assets remained were not sitting in an account the IRS could easily seize. What he apparently didn't fully understand, or perhaps didn't want to think through in the panic of the moment, was that our operating agreement made both of us equally personally liable for the business's tax obligations, regardless of who had actually mismanaged the payroll classifications or who had physically moved the money. The IRS does not care when pursuing an LLC's payroll tax liability, which partner made the underlying mistake. Both owners are on the hook, and emptying the account didn't protect Anthony from that liability. It simply guaranteed that when the IRS did come looking for the money, there would be nothing left in the business itself to pay it, meaning both of our personal finances were now exposed. The call came almost exactly 3 weeks after I discovered the empty account. I remember exactly where I was, sitting in my home office, reviewing my own family's finances, still trying to process everything that had happened, when my phone rang with a Washington, D.C. area code I didn't recognize. The agent on the line identified herself as being with the IRS's Small Business/Self-Employed Division and explained, in the careful, procedural language these calls always seem to follow, that our business had been flagged for a compliance review regarding payroll tax deposits over the previous 6 quarters. She explained that both listed owners of the LLC, myself and Anthony, would need to respond to a formal notice that would be arriving by mail within the following 2 weeks, and that failure to respond appropriately could result in additional penalties and potentially personal liability assessments against both owners individually. I want to describe what that moment felt like because I think it's important. I had spent almost a decade building a reputation, in my professional life, as someone meticulous and trustworthy with financial matters. And here I was, facing a federal tax liability I had not created, did not know about until weeks earlier, and could not undo, because my own brother had made a series of decisions, without consulting me, that had put both our names on the hook for money he had already spent trying to protect himself. I called our attorney immediately after hanging up with the IRS agent. And I called Anthony again, though this time, I approached the conversation very differently than the panicked, confused call 3 weeks earlier. By this point, I had spent 3 weeks with an attorney, an accountant, and a considerable amount of quiet, focused anger, reviewing every document related to our business. I understood, far better than Anthony likely realized, exactly how exposed he actually was, not just to me, but legally. I called him and said calmly, "Anthony, the IRS just called. They're sending a formal notice about payroll tax compliance. Both our names are on this, which means both of us are personally liable for whatever they determine we owe, plus penalties and interest." There was a long silence. Then he said quietly, "I moved the money to protect us, Mike. I didn't want the IRS to just take everything from the business account." "Anthony," I said, "moving the money didn't protect us. It protected you, from me, temporarily. It did nothing to protect either of us from the IRS, because personal liability doesn't disappear just because the business account is empty. All you did was make sure that when this bill comes due, there's no business money left to pay it with, which means it comes directly out of our personal assets instead. Yours and mine, equally." I let that sink in for a moment before continuing. "So right now, you and I are going to have a very different conversation than the one we had 3 weeks ago. because you have $184,000 sitting in an account somewhere, and I have an operating agreement that says exactly how this liability gets allocated between us if we can't resolve it amicably. I would strongly suggest we resolve it amicably. Here is where the story turns, and it's the part I'm most proud of, because it's the part where careful planning, made years earlier during a moment of calm rather than crisis, ended up protecting me when everything else fell apart. When Anthony and I first formed the business 8 years ago, I had insisted, over his mild objections at the time, since he thought it was unnecessarily cautious for two brothers who trusted each other, on including a specific provision in our operating agreement regarding financial misconduct between partners. The provision stated, in essence, that if either partner was found to have removed company funds without the other partner's knowledge or consent, and that removal directly contributed to a financial liability affecting the company or its owners, the offending partner would be personally responsible for covering that liability in full, up to and including reimbursing the other partner for any resulting personal financial exposure. At the time we signed it, 8 years ago, it felt like a formality, the kind of clause a cautious younger brother insists on, including that everyone assumes will never actually matter. Anthony had signed it without much complaint, likely because he never imagined a scenario in which he himself would be the one triggering it. Our attorney confirmed what I already suspected. This provision was clear, specific, and enforceable. Anthony's decision to unilaterally move $184,000 out of the business account, without my knowledge, directly ahead of a tax liability he knew was coming, was almost a textbook example of exactly the scenario that clause had been written to address. I laid this out for Anthony plainly. You have two options. You can return the funds to the business account so we can properly address the IRS liability together, as equal partners, the way this business has always operated. Or, under our operating agreement, I can pursue you personally for the full liability plus damages, and given what our attorney has already reviewed, I would win that case without much difficulty. Anthony did not take this well at first. He accused me of threatening my own brother, of caring more about a contract than family, of not understanding the pressure he'd been under trying to keep the business afloat while quietly managing a tax problem he was too embarrassed to admit to me. I understood to some degree where that embarrassment came from. Admitting to your own brother, the careful, methodical one, the accountant, that you've mismanaged payroll taxes for over a year is not an easy conversation to initiate. But understanding his embarrassment did not change the fact that his solution to that embarrassment had been to quietly move a significant sum of shared company money into an account I didn't know existed, rather than simply telling me the truth months earlier when there might have been more options available to fix it properly. I told him this directly. Anthony, if you had come to me 8 months ago and said, I've made a mistake with payroll classifications and we're behind on deposits, we could have worked with our accountant to develop a payment plan, potentially avoided some of these penalties entirely, and handled this as partners, the way we're supposed to. Instead, you handled it alone, in secret, and made a series of decisions that turned a fixable problem into a much bigger one for both of us. After several more tense conversations over the following 2 weeks, conversations I kept largely factual and unemotional, precisely because I understood that emotion would only give Anthony room to reframe the situation as a family conflict rather than what it actually was, a straightforward breach of our written agreement, Anthony agreed to return the full $184,000 to the business account. With the funds returned, our attorney and accountant worked together to respond formally to the IRS notice. We proactively disclosed the misclassification issue rather than waiting for the IRS to fully uncover it themselves, a decision our attorney strongly recommended, since voluntary disclosure and cooperation generally result in more favorable treatment regarding penalties than an adversarial audit process does. We ultimately negotiated a payment plan directly with the IRS covering the underpaid payroll taxes plus penalties and interest, totaling just under $206,000 once everything was calculated, a liability that, because the funds had been returned to the business account, the company itself was able to cover through a structured payment arrangement, without either Anthony or me needing to personally liquidate assets to cover it. It was not a painless resolution. The business took on real debt to manage the payment plan, and profitability over the following year was significantly reduced as a result. But it was a resolution that both Anthony and I survived, financially, as individuals, which would not have been the case if Anthony's original plan, quietly keeping that $184,000 for himself while leaving me personally exposed to whatever the IRS ultimately assessed, had been allowed to stand. Our accountant told us afterward that the voluntary disclosure approach likely saved us somewhere between $30,000 and $50,000 in additional penalties compared to what we would have faced had the IRS uncovered the misclassification issue on their own through a full audit. It was a small silver lining in an otherwise difficult year, but it mattered, both financially and as a reminder that handling a crisis honestly and transparently, even after it had already spiraled far further than it ever needed to, still produced a better outcome than continuing to hide from it. Beyond resolving the immediate tax crisis, I made changes to how Anthony and I operated the business going forward that I should, in hindsight, have insisted on years earlier. I resumed direct, hands-on oversight of all financial operations, rather than the quarterly review arrangement I'd shifted to years before. We implemented dual signature requirements on any transfer above $5,000, meaning no single partner could move significant funds without the other's explicit knowledge and approval. And we brought in an outside CPA firm to conduct quarterly compliance reviews specifically focused on payroll tax deposits, removing any ambiguity about whether obligations were being met in real time, rather than discovering problems more than a year after they'd begun. Anthony, to his credit, did not fight these changes. I think, in the aftermath of nearly losing a significant portion of his personal assets to an IRS liability he'd tried and failed to quietly outmaneuver, he understood, perhaps for the first time in 8 years, exactly how much the structure and discipline I'd insisted on from the beginning had actually been protecting both of us all along, not just from outside risks, but from each other, in moments of panic or poor judgment. Anthony and I still run the business together today. Our relationship, I won't pretend, is not exactly what it was before all of this happened. There is a formality to our financial dealings now that didn't exist 8 years ago, when a handshake and a shared last name felt like enough. In some ways, I think that formality has actually made us better partners. We communicate more precisely now, document more carefully, and no longer operate on the kind of unquestioned trust that, as it turned out, left enormous room for exactly the kind of unilateral decision-making that nearly cost us both everything. I think about that operating agreement clause often, the one Anthony rolled his eyes at 8 years ago, the one that felt, at the time, like unnecessary caution between brothers who trusted each other completely. It turned out to be the single most important document either of us ever signed, not because I ever expected to need it, but precisely because I understood, even back then, that love and trust are not substitutes for clear agreements when real money and real consequences are involved. If you are going into business with a family member, or you already have, I want you to hear this clearly. The paperwork you draft during the calm, trusting early days of a partnership is not an insult to that trust. It is the only thing that will actually protect both of you when trust, for whatever reason, eventually breaks down under real pressure. Anthony didn't wake up one day intending to betray me. He made a series of small, secret decisions under mounting stress, each one feeling, to him in the moment, like a reasonable way to manage an unmanageable situation. That is how most financial betrayals between family members actually happen, not through grand villainy, but through panic, secrecy, and the mistaken belief that hiding a problem is easier than admitting it. What ultimately protected me was not luck, and it was not simply being right. It was a clearly written agreement, created years in advance, specifically designed for a moment neither of us ever wanted to imagine actually happening. If there's one thing I hope you take from this story, it's that protecting a relationship with real structure, real accountability, and real consequences isn't the opposite of trust. It's what makes trust sustainable in the first place. If this story reminded you of a business, a partnership, or a family financial situation of your own, let me know in the comments. And if you believe family businesses need real contracts, not just good intentions, type protected below. Thank you for watching. I'll see you in the next one.